Okay guys, today we're going to learn how to prepare a bank reconciliation. So the bank reconciliation is when we look at the difference between the dollar amount that's showing up on our bank statement as of a certain date. So on May 31st, the bank statement says you have $25,460 in this account. Our records are very likely going to have a different value. The purpose of the bank reconciliation is to understand what the difference is. And in many times, the correct balance is not the amount that the bank statement shows or the amount that our records show. We have to update and adjust our accounts, and we also have to take a look at the bank statement and make some adjustments to that while trying to determine what the correct amount should be. Okay, so this is what our finished bank reconciliation is going to look like. So we're going to start with the balance per the bank statement that's given to us, and we're going to start with the balance per our books. Okay, we're going to have to calculate that. I'll show you how to do that in just a second. But where we're going to end up, neither of these numbers is correct. This is not correct, and it's not correct because there's things we don't know about. We were not aware of the fact that we had bank service charges or that we made an error in recording a check. And we're just now learning that this amount here was a bad check. It was a rubber check. It bounced, right? And up top here, from the bank's perspective, they have no idea about these deposits in transit. When they made this when they printed us the bank statement on the 31st of May, if we made a deposit that same day, let's say after 2 or 3 o'clock in the afternoon, it might not be represented or posted to our account until the next day. In addition, they're outstanding checks. So if we wrote a total, and this it says deduct outstanding checks. So this is not just probably one check. It's multiple checks. Several of them added together equal 11,360. And so these would be checks that we've written, but somebody's hanging on to it and has not yet gotten around to making it to the bank. So let's say we cut somebody a check on the 27th of May. And we made the entry into our records, and that person has not taken the check to the bank to deposit it yet. There's no way in the world the bank would be able to know. They don't have a crystal ball, right? So until somebody brings that check in to deposit it, it's going to remain as an outstanding check. So at the end of the accounting period, there are things that the bank is unaware of: deposits in transit, outstanding checks, and there's things we are unaware of: bank fees, error in recording the check, NSF fees. Maybe the bank, somebody paid us directly through the bank and we didn't learn of the payment until we received the bank statement. And that's what this represents here, this $4,725. Okay, and when we're through here making this bank reconciliation, these both have to equal. This is the correct dollar amount that should show up in our financial statements. $23,750, not the amount that we originally showed, and not the amount, up here that the bank statement originally showed. It's neither of those. Okay? And when we're finished, we're going to need to make journal entries to take our cash from this amount that it currently is, which is incorrect, to this correct amount of $23,750. Okay, and if you're having trouble figuring out and you're saying, where in the heck did this $20,435 come from? It tells us up top that we started out with $15,085. It tells us that we had deposits of $75,100 and that we wrote a total of $69,750 in checks during May. That leaves us with an ending balance per our records of $20,435. If they wanted to be a little nicer, they could have just told us the dollar amount of cash per our records is $20,435, but they made us work a little bit more for it. So let's go on and get rid of this and go back up. And once again, let's revisit this here. So we start with we have the bank section up top, and sometimes you'll see these presented side by side. So we'd have the bank on the left and the books over here on the right. Or sometimes you'll have the bank section of the bank reconciliation up top, and then we'll have our records or our books section down here in the bottom. So let's take a look now at some of the things that took place here. Okay, we've already talked about the outstanding checks. We talked about the deposits in transit. We collected $4,725 on a note left for collection, so a note receivable. And the difference between these two, we're going to treat that as being interest. The difference between what they owed us and what they paid us is going to be interest. So that's the cost of borrowing money from somebody is interest. Now, I need to mention something about these errors. It says a check for $490 was returned with the statement it had been incorrectly charged by the bank as $940. So anytime you have deposits in transit or outstanding checks, they're going to show up on the bank side of the bank reconciliation. And anytime we're dealing with the other items such as return fees, service charges, NSF checks, non-sufficient fund checks, all that's going to show up down here in the book section. But the errors can show up in either place. Notice there's an error right here, and there's an error right here. So when we have an error, the first thing that we need to determine is, number one, who made the mistake. If the bank made the mistake, it's going to affect the bank section. If we made the mistake, it's going to affect the book section. Next thing we need to determine is in what direction was the error made. Was it in our favor or against us? So if we put too much cash in our records, then we need to reverse that. And if the bank's made a mistake, we're going to need to let them know about it so that they can fix it. So in this case, the difference between those two is this $450 here. The bank made it. Okay, so a check, we wrote the check for $490. They accidentally made it for $940. They took that much out of our account. Become aware of this by performing our bank reconciliation and say, hey guys, you guys made a mistake. It was a $450 mistake. You need to add that back to our balance, right? Okay, so let's take a look here. There's a mistake this time, and this is our fault. The check was actually $410. We accidentally recorded it as $140. That's a $270 difference. We didn't record enough of a cash reduction here, right? It was actually for $410, and we only recorded $140. So we need to go on and subtract that out. Let's see here. We had service charges of $40. Those service charges are always going to reduce our books. And let's see here. NSF check, $1,100. Elkhart Company wrote us a bad check. So the bank's going to take that out of our account. We didn't know about it until now when we received the bank statement. So we're going to make sure that that's reflected in the book section. When we're all done, these two numbers equal each other. But like I said, there is a necessity to make journal entries to update our book portion of this bank reconciliation. We don't care about the bank section, but the book section, we're going to need to make a journal entry. Let's take a look and see what those would look like. Okay, so like I said before, everything that involves the bank section we're not concerned with when it comes time to making a journal entry. So we can just go on and get rid of that. Okay? Here are the items that are going to require a journal entry. We have this $4,725. Okay? We need to update our records to show that we have $4,725 more dollars in cash. Okay? In addition to that, we need to make sure our debits and credits equal. Here we have $4,500 is what they borrowed, and this interest is revenue. Okay, so both of these are increased, or we have two credits here. This credit reduces a notes receivable. We're saying, hey, we've received this $4,500 from you. We're going to reduce our claim against you. Here, we're going to increase the amount of revenue. All right, in terms of the second part of this journal entry here, it's essential that we show the reductions to our cash balance. So we have 1,410 is the total of these three items right here. Okay, so we have a $270 error. When we made this mistake, well, initially we shortchanged our debit to accounts payable by $270. So when we made that mistake, we should have had $270 more worth of credits to account, or debits, I'm sorry, to accounts payable. We didn't do that correct the first time, so we're fixing it now. Accounts receivable. Elkhart, we're reestablishing this accounts receivable. We're not going to let him get away with giving us a bad check. We're putting this back on our books and saying, hey, Elkhart Company, you still owe us $1,100. This miscellaneous expense to service charge here, that's just a plain old expense, which is increased with the debit as well. Total of all those is $1,410. And if we took this beginning amount, $20,435, that's what's showing in our ledger as of that specific date. And once we make these two journal entries, we're going to end up updating our records, and we're going to have the correct amount, $23,750. And that is the amount that should show up in our financial statements.